what are some tips that new investors or mindsets that they can follow so that they don't make those mistakes and they stay consistent with their investments?
Really looking at, there's certain things that I think you should look at when you're investing. And for me, the most important thing, and this goes back to when I was studying accounting, is cash flows. Cash flows from operations is really the most important thing. If a company does not have strong cash flows, it's really, in my opinion, it's not worth investing in.
For somebody that's watching this video and like is just getting started with value investing, what are some of the main resources and lessons that you can teach them so they can get started without making so many mistakes?
Best resource I can recommend someone who just started out is...
Okay, hi everyone. We just finished from the Berkshire Hathaway meeting and we're here with
Monique French.
Monique, we saw a lot of stuff happen at the Berkshire meeting. We heard a lot of the things that Warren Buffett was talking about, as well as Greg and the other team members. What is the biggest takeaway from the conference from yourself?
I think that they obviously are ready for the transition from their perspective. I think the shareholders need more exposure to Greg and Ajit for us to get to know them in the broader sense. They're very accomplished, obviously. We heard some really great responses on the business from Ajit and from Greg. I think we want to hear more about them outside of work, the way we know Warren has kind of these values, and again, just get to know them as human beings a little bit more.
Warren Buffett is somebody that we all love and love to hear what he says. But for somebody who's just getting started into investing, you know, it's great to learn from these great investors like Peter Lynch, Warren Buffett, etc. And they want to learn more about Warren Buffett and they're just like starting their investment journey. Do you have like any recommendations of how they can start to do that?
Oh, for sure. I think Warren, in his broadest sense, there's Snowball, which is a book on Warren Buffett, which is a great one to read. There is another book that focuses on him more as the investor only, where Snowball is wider and talks about his whole life. Peter Lynch is great too, because Peter Lynch complements Warren in that Peter Lynch is very much coming from a different angle but arrives at the same place that Warren does, in that he's buy what you know, keep it simple, use your common sense, and don't be afraid to be incremental. Go at your pace. Don't let the outside world or kind of trying to impress anyone else drive you. So reading the books is a great place to start. They're very readable books. And secondly, just listening to some of the principles. One of Warren Buffett's annual letters sets out the things he looks for in a business, and that's a great one to find. It's like, I think he has 10 things he writes down there. So that's a great, it's one page. You can read that and really have a sense of kind of thinking through as a starter, and just buy be one share and start there and see what happens.
Come here, guys. This event is totally worth it. And the other thing is, we don't know how long Warren Buffett's going to be here. So if you can make it to the next one, highly recommend it.
Very much.
I think a great quote that Warren Buffett says in regards to that is that it's better to be approximately right than precisely wrong.
Exactly.
So when it comes to valuations, for example, what have you seen that people do where they're trying to like approximate the value of a company to like a cent basically that like works and doesn't work? Like what have you noticed in terms of that?
Well, I think sometimes we think it's all about just like stick things in the spreadsheet and it will work. The spreadsheet is just a tool to give you direction, right? It's like everybody's like, every business plan is wrong. You never hit the number in the business plan. What the business plan or the spreadsheet is helping you to do is just, to your word, process. You're thinking about, by doing that spreadsheet, what are the levers that matter to the company? But it will never be the exact number you put down there. So the spreadsheet is actually trying to point you to the non-quantifiable, the non-numerical things that you need to think about, because if you see where in your spreadsheet, boy, I don't know, maybe prices, if you do price this way or price that way, it's going to affect it. What you're then thinking about is, does the company have a moat? Does management have the ability to raise prices? But that's not a spreadsheet thing. It's just showing you the sensitivity. So I think it's important to know that the spreadsheet is not the driver of your decision. It's just helping you to think about what are the things outside in the real world that you should be thinking about in terms of how you think about the company. And the number in the spreadsheet is never going to be the number. It's just a guiding you somewhere.
Okay, so we're here with...
My name's Andrew Thomas. Nice to meet you.
Andrew, nice to meet you. In terms of the research process that goes into picking a good value investing pick, could you share about like what your process is and like what you would recommend for somebody who's just like starting into value investing?
Sure. Well, I mean, if you like to read, if you can learn the parameters of what value looks like to you and to other experts, then you can go anywhere and look. I love consuming the wise media that is so readily available now, like what you're doing. I started with Monique French, and he made the suggestion of looking at Datorama, of whale wisdom, and shamelessly cloning successful people.
One more question I have is, for people that are just getting into investing, what do you think is the biggest mistake that they can make, and what's something they can do to avoid it?
Well, I guess the biggest mistake would be not starting as soon as you possibly can to let the miracle of compounding work for you over the decades of your life. I suppose the second biggest mistake would be thinking that you've waited too long. And because we are all benefiting from the miracles of the allopathic medical model, I think we're all going to end up surprising ourselves with how long we're going to work and how long we're going to live. And investing in your future is always a good idea. It doesn't matter if you're 40, 50, 60. Starting is a really good idea. And I think the third biggest mistake would be to not automate the process, to not let it become a habit, to think of it as something that you're going to do later, or that you're going to outperform, or you're going to try to hit a home run, instead of just letting the time value of money work for you. So starting as soon as you can, not thinking that you've missed out, and starting no matter where you are, and then making it an automated and mechanical process for the majority of your investment, I think are all great recipes for long-term success and financial dignity in your later years.
Hi everyone, we're here at the Berkshire Conference with
Dan Buckfire from Detroit, Michigan.
Thanks for sharing. So I'm curious, what was the biggest lesson that you learned from the Berkshire Conference this time?
What was the biggest lesson? It's really consistency of Warren Buffett's, his philosophy on investing, on life, and he's pretty consistent, and he's been consistent for years and years and years. And I think the lesson that I learned is consistency is very important in the way you live your life, and I think he has, and I think that's the lesson I learned from him.
I'm curious, what do you think is the biggest investing mistake that you've made, and what's the biggest lesson that you learned from it?
The biggest mistake I've made is sometimes staying too long with the stocks. I've kind of followed what Warren Buffett does, and a lot of times I'll buy a stock and I'll hold on to it. My intention is to hold on to it forever. And I've made sometimes, even when I knew that the stock was way overvalued and I probably should take at least some profits, I still held on to the stock. And every day I learn that same lesson. And there's a few stocks I own right now where I've seen it go way up, and I knew it was way overvalued, and I didn't take any profits, and it's gone way back down. So I think my mistake is sometimes holding on to stocks too long. As far as what I've learned is in investing, I think really looking at, there's certain things that I think you should look at when you're investing. And for me, the most important thing, and this goes back to when I was studying accounting, is cash flows. Cash flows from operations is really the most important thing. If a company does not have strong cash flows, it's really, in my opinion, it's not worth investing in. And so the thing I've learned over the years is really the most important thing to look for is cash flows in a company.
Thanks for sharing. Now, one more question I wanted to ask is, would you recommend that people focus on specific sectors or industries as they're getting into value investing, or would you just recommend to look around?
I think you can look for certain parameters, and I think everybody, there's no secret. I mean, everybody has their own secret sauce of what they like or what they're interested in. For me, and it's counter to what Warren Buffett, I've been successful investing in retail stocks, and for whatever reason, it's an industry that I understand, so I think if you're looking for an industry, it should be something that you thoroughly understand how it works before you invest.
Okay, so we're here with
Milan.
Milan, nice to meet you. For somebody that's watching this video and is just getting started with value investing, what are some of the main resources and lessons that you can teach them so they can get started without making so many mistakes?
The best resource I can recommend someone who just started out is the little book that beats the market from Joel Greenblatt. I think it's very easy to read, and it tells the basics, the concepts of it.
Yeah, that's a great book. I'm curious, something that a lot of people struggle with in the beginning is really understanding company valuation.
Yeah. Also a thing is that people are very often too emotional, and they buy a company, 3 months after they buy, it drops 20-30% or something like that, and then they sell because they are afraid of losing more money, but that's the point where you have to go in even more. And I think that's the biggest hurdle for most of the people.
Cool. Hi everyone, we're here with
Angel Wei.
When it comes to investing, there's so many mistakes that people can make, especially when they're beginners and they're just getting started. So what do you think are the most important important mistakes that people should avoid when they're just starting to invest?
I think it's not knowing enough. I didn't start with being an investor. I studied media and journalism for my degrees. But when I started to learn about investment, there's just a lot of news and a lot of ongoing situations that you need to be aware of. Not only just pure investment by itself, but also there's a lot of different factors that are ongoing, like political geopolitics, also about the whole atmosphere of the economics. So there's a lot aspect to it. So not knowing enough or not being up to date enough, I think is a mistake that people can make when they're trying to make an investment.
Now, when it comes to your own personal investments, as an individual investor, what do you think are like a couple of steps that people can take to like make their first investment and do it in the right way?
So personally, I guess it's to learn first, because the education is all it is about. You gotta know enough. Even Warren Buffett said, right? Like he's like, you should not invest in an industry or a company that you do not understand. So I think learning from that is the learning point is very important. So I think it is follow the news, learn the data, and take the steps as well. Because you cannot, you shall not expect every investment is a successful one. Even Warren Buffett, Charlie Munger makes mistakes. So I guess it's a emotional stability also matters in that sense.
Yeah, emotional stability is something that was talked about on the conference, and it's something really important because a lot of people they make one bad mistake, which is very normal like you said, but then after that they don't continue to improve and ensure that they're securing their financial future, right? So what do you think is a good mindset to have of a principle they can follow so that if things are not going well in the market, people still stick through their investments and find a way out of that situation?
I guess it's to take a step back to look at it from a third perspective, so you don't take your emotion with it every time that you make this decision, or if there's gains or loss.
Awesome. Thank you so much for sharing your experience with us.